All right, buckle up everyone, because today we're diving deep into the sometimes murky, sometimes fascinating world of financial reporting.
Murky is right. But we'll bring our flashlights, don't worry.
That's right. Specifically, we're going to be focusing on IFRS 15 and 16, using some great material from ACCA, their student guide, Mastering Financial Reporting.
Yeah, these standards, they're designed to make financial statements clearer, more transparent. But let's be honest, sometimes they just make things more complex.
That's true. It's true.
So what we're going to try and do today is unpack those standards, really see how they impact the way companies report their financials, and then, importantly, what that means for anyone trying to make sense of those numbers. Investors, analysts, even just the average person trying to understand business.
Exactly. We're going to look at some real head-scratcher situations like retrospective volume discounts, where you think a company's made a certain amount of revenue and bam, they got to go back and adjust it.
Oh, yeah, those are fun.
And then there's lease accounting. Big changes in recent years bring all these liabilities onto the balance sheet that used to be kind of hidden.
All about getting the full picture, right? The real deal, not just the surface level.
Absolutely. So let's kick things off with IFRS 15, revenue from contracts with customers.
The big one.
Yeah, now I always thought revenue was pretty straightforward. You sell something, you get the money, boom, revenue. But IFRS 15, with its five-step model, paints a much more nuanced picture.
Oh, yeah, way more nuanced. It's not just about when the cash hits your account. It's about when that revenue is truly earned.
Okay, color me intrigued. Walk me through those 5 steps.
All right, step 1. Identify the contract with the customer. Sounds simple, right?
Seems like it.
But hold on, because not every agreement actually makes the cut to be a contract under IFRS 15.
Okay, so what's the catch? What makes a contract official in the eyes of IFRS 15?
There's criteria, got to tick all the boxes, both parties got to prove it, rights and obligations spelled out clearly, payment terms set, and commercial substance. Got to have that.
So not just a handshake deal, you need real commitment, both sides.
You got it. And our source material, they had a great example. Something about a machinery supply contract with a cancellation clause really illustrates this point.
Yeah, I remember. So if the buyer can just back out, no penalty, does it really count as a sale?
That's the question IFRS 15 asks. Is there a real obligation there? If not, it might not even be a contract in the first place. So right from step 1, things can get interesting.
Makes sense. So step 1, already forcing companies to be more upfront about their sales agreements.
Transparency, that's the goal.
Love it. All right, so we've cleared the contract hurdle. What's next?
Step 2, identify the separate performance obligations within the contract. So figuring out each distinct good or service the company's promised to deliver.
Okay, I'm following so far. Break it down.
You've got a contract, right?
Yeah.
But within that contract, you might have multiple things going on, multiple promises being made.
Like if a company sells a package deal, they got to break down each element.
Exactly. And sometimes those elements are distinct. They can stand on their own. Sometimes they're bundled, intertwined, can't have one without the other. And that makes a difference.
This allocation thing, it sounds pretty tricky. How do companies figure out how much revenue belongs to each piece of the puzzle?
Yeah, good point. Our source material, they use the example of ZTech, a software and professional services company, really illustrates this.
Okay, tell me about ZTech.
So they offer 2 software packages, Zero Inventory and Inventory X. With Zero Inventory, you can buy the hardware, professional services, hosting, all separate contracts. But with Inventory X, the hardware is bundled with those services.
So with zero inventory, each element is distinct, standalone, so they're treated as separate performance obligations.
Bingo. But with Inventory X, the hardware and services are a package deal, can't separate them, so single performance obligation.
Wow, so even something as simple as bundling can have a big impact on how revenue is recognized.
Substance over form, that's the key takeaway here. We got to look at the reality of the transaction, not just how it's presented.
All right, step 2 definitely makes you think.
On to step 3, determining the transaction price.
Okay, price, that should be easy. It's just the number on the sticker, right?
If only it were that simple. The transaction price is the amount the company expects to receive, but it's not always a fixed number. Think about discounts, rebates, all those things.
Right, variable consideration. IFRS 15 has rules for that, doesn't it?
Oh, yeah, it does. Companies can only recognize revenue if it's highly probable they won't have to reverse it later. So if there's a chance of a discount or refund, can't count your chickens before they hatch.
Makes sense. Prevents companies from inflating their revenue with sales that might not actually be worth the full price.
Right on. Our source material had a perfect example, a tablet company, Technova. They had this contract where the price per tablet dropped if the buyer bought a certain amount.
Okay, and I'm guessing the buyer ended up hitting that target.
Surprise, surprise, they did. So
Uh,
Technova had to go back and adjust their revenue, even though they'd already reported those sales at the higher price.
Wow, that's a big deal. Really shows how IFRS 15 keeps companies honest.
Transparency, remember?
Absolutely. All right, so we've got the contract, the performance obligations, the transaction price. What's next in this IFRS 15 adventure?
Step 4, allocation time. Remember those separate performance obligations we identified? Well, now we got to divvy up that transaction price, figure out how much each piece is worth.
So we're slicing the pie, but how do you determine the size of each slice?
Standalone selling price, that's the key. What would the company charge for each item if it was sold on its own?
Okay, so even if it's a package deal, you got to break it down, look at the value of each component.
Exactly. And this is where things can get really interesting with those bundled contracts.
I bet our source material has a case study for this.
They always do. Think about SkyTalk Telecom Company. They offer a free smartwatch when you sign up for a 2-year data plan.
Free, in quotes, because you're locked into that contract.
Exactly. So even though it's marketed as a package deal, they're actually two separate performance obligations, the smartwatch and the data plan.
So SkyTalk has to figure out what each one would cost on its own, and then split the revenue accordingly.
Precisely. They can't just recognize all the revenue up front. They got to spread it out over time based on the standalone values of each element.
Okay, IFRS 15, you're definitely making companies work for their revenue recognition.
No more easy shortcuts.
So we've identified the contract, the performance obligations, figured out the transaction price, allocated it. What's the final step?
Step 5, the grand finale. Actually recognizing that revenue.
The moment of truth.
Huh?
And this is where we decide if it's recognized over time or at a point in time.
You got it. Remember, it all depends on when the customer actually gains control of those goods or services.
So like a construction project where control is transferred gradually, revenue is recognized over time. But if it's a product you buy off the shelf, bam, revenue recognized all at once.
Perfect example. And IFRS 15 provides indicators to help companies make that call. Things like physical possession, transfer of legal title. When payments received, it's all about pinpointing that moment of control transfer.
So even the timing of revenue recognition can have a big impact on a company's financial statements.
Absolutely. And that brings us to the end of our IFRS 15 journey.
A whirlwind tour. But I feel like I've learned a lot.
And now, for something completely different, IFRS 16, leases. Another area where things have gotten, shall we say, interesting in recent years.
Oh, yeah, big changes there, bringing those lease obligations out into the open, onto the balance
Well, the
sheet.
transparency.
Exactly. But before we dive into the specifics, can you give me the quick backstory? Why did IFRS 16 come about, and what problem was it trying to fix?
Well, before IFRS 16, companies could keep a lot of their lease obligations off the balance sheet. Those operating leases. They were just an expense, no liability recorded.
It's kind of like sweeping those obligations under the rug.
Yeah, and investors, they weren't happy. They wanted to see the full picture, the real debt levels, not just a pretty facade.
Makes sense. So how does IFRS 16 actually work? What are the key concepts we need to understand?
All right, first things first, a lease under IFRS 16 is a contract that gives you the right to use an asset for a certain period, and you pay for that right.
Okay, so far so good.
Now, here's the big change. That right to use the asset, it's recognized on the balance sheet as an asset, a right of use asset, or ROU asset for short.
Ah, the ROU asset. I've heard whispers of this mythical beast.
It's not a myth. It represents the lessee's right to use that underlying asset for the lease term, and it comes with a partner in crime, a lease liability.
So instead of just an expense, we've got an asset and a liability, like we're treating the lease more like a loan.
You got it. And this approach, it gives everyone a much clearer picture of a company's true obligations.
Okay, I'm starting to see the logic here, but can we walk through an example to see how this works in practice? I'm a hands-on learner.
Let's do it. Imagine Rivercore. They're leasing some equipment for 5 years, starting January 1st, 20X1.
All right, what's the payment structure?
Lease payments, they're $2,000 upfront, followed by 4 annual payments of $2,000 at the start of each year after that.
So they're paying at the beginning of each year, and just to spice things up, let's say the equipment's worth $8,000. The present value of those lease payments is $6,075, and the interest rate built into the lease is 12%.
Perfect. Now, on day 1, January 1st, 20X1, Rivercore has to recognize that ROU asset and the lease liability.
Okay, how do they figure out what those are worth?
Lease liability first, it's easy, just the present value of those future payments, which we know is $6,075.
And the RU asset, a bit more involved, I'm guessing.
You bet. We start with that lease liability, $6,075, and then we add in any lease payments made before the lease starts.
In this case, they made that initial payment of $2,000, right?
That's it. So the ROU asset, it starts its life at $8,075.
All right. They got the asset and liability on their books. What happens next? How do they account for this lease throughout the year?
Well, that ROU asset, it gets depreciated either over its useful life or the lease term, whichever's shorter.
Let's assume the lease term is shorter, so 5 years.
Mm.
We depreciate that $8,075 over 5 years.
Exactly. So that means an annual depreciation charge of $1,650. And by the end of the year, December 31st, 20X1, the ROU asset is down to $6,460.
Makes sense. And what about the liability?
The lease liability, it acts a lot like a loan. We use the effective interest method, so it goes up with interest expense but down with each lease payment.
Okay, how do we calculate the interest expense for the year?
We take that starting lease liability, $6,075, multiply it by that 12% interest rate, and that gives us $729 in interest expense.
So at the end of the year, the lease liability should be, let me see, $6,804.
Not quite. We got to factor in that $2,000 payment they made at the beginning of the year.
Right. So the lease liability actually ends up at $4,804 after that payment is deducted.
You got it. And because those payments are made at the beginning of each year, they also need to recognize a current liability of $2,000 for the payment that's due next year.
Okay, so if I were looking at Rivercore's balance sheet at the end of the year, I'd see an ROU asset of $6,460, a non-current lease liability of $4,804, and a current liability of $2,000, all thanks to this lease.
Precisely. And that's the magic of IFRS 16. It forces companies to show their cards, no more hiding those lease obligations.
Transparency reigns. This has been super helpful in understanding how IFRS 16 works from the lessee's perspective, the companies doing the renting. But what about the lessors, the companies owning the assets and leasing them out? How does IFRS 16 affect them?
Great question. For lessors, IFRS 16 hasn't been quite as revolutionary. They still get to classify leases as either finance leases or operating leases.
So the old distinction still applies to the companies doing the leasing out.
That's right. If the lease basically transfers all the risks and rewards of owning the asset to the lessee, it's a finance lease. Otherwise, it's an operating lease.
And the accounting depends on which type of lease it is, right?
Absolutely. For finance leases, the lessor essentially treats it like they've sold the asset, they take it off their balance sheet, recognize the lease receivable, and they get to recognize finance income over the lease term.
So kind of like a sale, but they still get those ongoing lease payments.
Exactly. But for operating leases, the asset stays on the lessor's balance sheet and they just recognize rental income as it comes in.
Okay, so for the lessors, things were a bit more aligned with how they used to be under the old IAS 17.
That's right. IFRS 16's main focus was on making things more transparent from the lessee's side, the companies doing the renting.
Makes sense. Now, before we move on from leases, what about those sale and leaseback transactions? They sound like they could get pretty tricky.
They can be. Basically, a company sells an asset but then immediately leases it back from the buyer.
So they get cash for the asset, but they still get to keep using it. Interesting strategy.
It can be, but the accounting gets tricky. It all comes down to whether that initial sale actually counts as a sale under IFRS 15. Remember our 5 steps.
So we got to go back to those revenue recognition rules to figure out if the seller really gave up control of the asset.
Exactly. If it's a genuine sale, the seller removes the asset from their books, recognizes an ROU asset for the leaseback, recognizes the lease liability, and records any profit or loss on the sale.
Okay, but what if it's not a real sale?
Then it's treated as a financing arrangement, which is a whole different ballgame. The asset stays on the seller's balance sheet, the cash they got is treated as a liability, and those lease payments are basically like interest expense on that liability.
So there's a lot of judgment involved in these sale and leaseback transactions.
Yeah, definitely. Got to look at the details, figure out what's really going on.
IFRS 16, you've definitely made lease accounting more complex, but also more transparent.
It's all about striking that balance. And speaking of complex, are you ready to tackle some other challenging areas? Provisions, contingent liabilities, deferred taxes, those often leave people scratching their heads.
Oh yeah, right on the challenge. Let's start with IAS 37. Provisions, contingent liabilities, and contingent assets. Lots to unpack there.
Let's do it. Starting with provisions, what are they? Think of it like setting aside money for something you're pretty sure you'll have to pay in the future, but you're not 100% sure when or how much.
So like a rainy day fund for potential obligations.
Exactly. Warranties, environmental cleanup costs, restructuring expenses. Those are some common examples.
So real obligations,
Mm.
but with some uncertainty around the timing or the amount. I'm guessing there are rules around when a company has to actually record a provision, right?
Absolutely. IAS 37 lays out 3 key criteria.
Hit me with those criteria.
First, there's got to be a present obligation, something from the past that created this obligation, like a contract, a law, or even just a valid expectation the company's created, like promising certain benefits to employees.
So you can't just say, oh, something bad might happen someday, let's make a provision. There needs to be a real reason to believe an obligation exists now.
Exactly. Second criteria, it has to be probable that you'll need to use resources to settle that obligation, more likely than not that you'll have to pay up.
So more than a 50% chance, not just a remote possibility. What's the third hurdle?
You got to be able to estimate the amount of that obligation, and it's got to be a reliable estimate, not just a wild guess.
So those are the 3 tests a potential provision has to pass. To really see how this works, can we use one of the case studies from the source material?
Great idea. They had one about AlphaCo. On January 1st, 20 Excel, they gave a loan guarantee to a bank for a loan taken out by BetaCo.
Okay, so Alpha's on the hook if Beta defaults.
Right, and at the time, Beta was doing great, financially sound, but over 20X1, things went south. And by June 30th, 20S1, it was looking very likely Beta would default, meaning Alpha would have to pay up.
All right, so let's apply our provision criteria here. Do you think AlphaCo needed to recognize a provision at the end of 20XF?
Not at the end of 20X, no. Even though that guarantee created a present obligation, back then it wasn't probable that Alpha would have to pay anything. Beta was in good shape at that point.
So no provision just yet, but I'm guessing they'd still need to disclose that guarantee somewhere, right? Transparency and all that.
Absolutely. Got to be upfront about those potential obligations, even if they don't meet the criteria for a provision, so they disclose it as a contingent liability.
We'll come back to those, but first, back to Alpha. Fast forward to the end of 20X1, do you think they need a provision now?
By then, yeah, things have changed big time. It's highly probable Alpha's got to pay up to cover Beta's default.
So all 3 criteria are met now: present obligation, probable outflow, and they can probably estimate the amount based on the loan details.
Bingo. So AlphaCo, they need to recognize a provision in their financial statements at the end of 20X1.
Okay, so we figured out whether to recognize a provision. Now, how do we measure it? How do we put a number on that uncertain obligation?
Good question. IAS 37 says we need to measure provisions at the best estimate of what it'll cost to settle the obligation.
So not the worst case scenario, but the most realistic estimate based on what we know.
Exactly. And if there's a big difference between paying now versus later, we got to factor in the time value of money, discount that provision to its present value.
$1 today is worth more than $1 tomorrow. Makes sense.
Now, here's where it gets tricky. What about uncertainties in that estimate? How do companies deal with that?
Yeah, that's a good point. Estimations are never perfect.
Right. So if it's a large group of items, like warranty claims on a bunch of products, companies can use statistics, probabilities, all that fun stuff.
Weighing the odds, basically. But what if it's a single item, like a potential lawsuit?
For single items, IAS 37 says go with the most likely outcome.
So always using the best available information to come up with the most realistic estimate.
That's the goal. And once we have that provision on the books, there are rules about how it can be used, right?
Oh, I bet there are. No funny business allowed.
Exactly. Provisions can only be used for the specific purpose they were created for, so no raiding the warranty fund to cover unrelated expenses.
Got it. So IAS 37 keeps things strict, no creative accounting allowed.
Now, you mentioned restructuring provisions. There are some specific rules for those.
Yeah, those sound pretty intense, like major surgery for a company.
They can be. Restructuring provisions, they cover the costs of major reorganizations, things like redundancy payments, breaking leases, writing down assets, all that fun stuff.
Big decisions, big money involved. I'm guessing IAS 37 sets a high bar for when companies can recognize those provisions.
You bet. Got to have a detailed plan, got to make it clear to everyone affected by announcing that plan. Can't just be a vague idea, it needs to be a real commitment.
And some costs are specifically excluded from those restructuring provisions, right?
You know it. Retraining employees, marketing, new systems, those aren't allowed in restructuring provisions.
So really focused on the direct costs of the restructuring itself.
That's the key. All right, now remember how we said AlphaCo would need to disclose that loan guarantee even if they didn't recognize a provision? That's where contingent liabilities come in.
Okay, remind me, what are those exactly? How are they different from provisions?
Contingent liability, it's like a potential obligation, something from the past that might require you to pay up in the future. But it all depends on whether some uncertain future event happens and the company doesn't have full control over that event.
So like a possibility of having to pay, but not definite yet.
Perfect example, a potential lawsuit. Companies involved in a legal dispute, outcomes uncertain, they don't know if they'll have to pay anything.
And they don't record a liability for this.
That depends on how likely it is they'll have to pay. IAS 37 breaks it down into 3 levels of probability: probable, possible, and remote.
Okay, let's break down those levels.
Probable means more likely than not, so greater than 50% chance of having to pay. Possible means less likely than probable, and remote means very unlikely to happen.
So how does this connect to contingent liabilities?
If it's probable and you can reliably estimate the amount, boom, it's a provision, which we already covered.
But if it's just possible?
Then it gets disclosed as a contingent liability in the notes to the financial statements, so not on the balance sheet itself, but you get the information.
And if it's remote?
No disclosure required.
So contingent liabilities, all about transparency, even if it's not a full-blown liability yet, got to be upfront about those potential obligations.
Exactly. Full disclosure, that's the name of the game.
This has been a great overview of provisions and contingent liabilities. But before we move on, what about contingent assets?
Contingent assets, think of them as the flip side of contingent liabilities. Potential for something good to happen, maybe you'll receive some money, but it's not a sure thing.
So like winning a lawsuit instead of losing one.
Exactly. But here's the key. We're super cautious with contingent assets. You can't recognize them on the balance sheet unless it's virtually certain you'll get that benefit.
So you got to be super confident it's going to happen. What if it's probable but not virtually certain?
Then you disclose it in the notes to the financial statements, give some details, how much it might be worth, all that.
Okay, so again, transparency is key, even if we're not recognizing the asset itself.
You got it. IAS 37, making sure everyone gets the full picture, potential risks, and potential rewards.
Great stuff. All right, we've tackled provisions, contingent liabilities, contingent assets. Now let's move on to another head scratcher, deferred taxes.
Oh yeah, deferred taxes, they can be a real brain twister.
They can. So let's start with the basics. What are they and why do we even need to worry about them?
Deferred taxes, they pop up because of timing differences, sometimes how we report income and expenses for accounting. It doesn't quite match up with how they're treated for tax purposes.
So like a clash between the accounting world and the tax world.
Exactly. And that clash, it can lead to either deferred tax assets or deferred tax liabilities.
So it's not just about what you owe in taxes now, it's also about what you might owe or be able to claim back in the future.
Bingo. And IAS 12, that's the accounting standard that governs all things income tax, it tells us how to deal with these temporary differences.
Okay, let's dive deeper. What's the difference between current tax and deferred tax?
Current tax, that's the straightforward one. It's what you owe or are owed for the current period. Based on your taxable profit, it's your current tax bill or refund.
So it's like dealing with a tax man right now, based on current tax laws.
Exactly. Now, deferred tax, that's an accounting adjustment. It's looking ahead, anticipating the impact those timing differences will have on your taxes down the road.
So we're not actually paying or receiving this deferred tax right now, but we're recognizing it because it will eventually impact our tax position.
You got it. And this anticipation, it can either lead to a deferred tax asset, which is like a future tax benefit, or a deferred tax liability, which is like a future tax obligation.
Okay, let's break those down. When would a company recognize a deferred tax asset?
Deferred tax asset, it arises when you've overpaid tax in the current period, or you expect to pay less tax in the future, all because of those timing differences.
So it's like having a credit with the tax authorities. You can use it later to offset future liabilities.
Exactly, like a tax voucher for later.
But there must be rules around when you can actually recognize this asset, right?
Oh, absolutely. To recognize a deferred tax asset, it needs to be probable, meaning more likely than not that you'll actually be able to use that tax benefit in the future, and you got to be able to measure it reliably. No guesstimates here.
So no banking on a potential tax break unless you're pretty sure you'll get it and can put a solid number on it.
Precisely. Now, what about deferred tax liabilities? When do those come into play? Deferred tax liability, it's the opposite. It's when you've underpaid tax in the current period or you expect to pay more tax in the future, again, because of those timing differences.
So it's like you're kicking the tax can down the road. You're getting a benefit now, but you'll have to pay for it later.
Perfect analogy. And there are a bunch of scenarios that can create these temporary differences. Let's look at some examples.
All right, hit me with those examples. I'm ready to dive into the nitty-gritty.
Okay, one common example is depreciation. How we account for the wear and tear of assets. Sometimes for accounting purposes, we use straight-line depreciation, spreading the cost evenly over the asset's useful life. But for tax purposes, we might use accelerated depreciation, getting a bigger deduction up front.
So if we're getting a bigger tax deduction up front, that means we'll have to pay more tax later, right?
You got it. And that's why accelerated capital allowances, that's what they call it in some countries, typically lead to a deferred tax liability. You're basically deferring that tax payment to a later date.
Makes sense. So it's not just about depreciation. Any situation where you get a tax break now that you'll have to pay for later, that could create a deferred tax liability. What about interest revenue? Does that come into play?
Oh, absolutely. Let's say you've earned interest on an investment, but you haven't actually received the cash yet.
Okay, yeah.
For accounting, you recognize that interest revenue as you earn it, even if you don't have the cash in hand yet.
But for tax purposes, wouldn't it be about when you actually get that cash?
You're right on the money. Interest revenue, often taxed when it's received, not when it's earned. So if you've accrued that interest but haven't seen the cash yet, boom, taxable, temporary difference, deferred tax liability time.
Another example of getting a benefit now, in this case, recognizing revenue, that'll have a tax consequence later. What about development costs? I vaguely remember those being treated differently for accounting and tax.
Development costs, great example. Under IAS 38, if certain criteria are met, you can capitalize those costs, treat them as an asset.
But for tax purposes, you might be able to deduct those costs immediately.
Exactly. And that creates a temporary difference because the asset's carrying amount, how it's valued on the balance sheet, is higher than its tax base.
Okay, so carrying amount higher than tax base sounds like we're talking deferred tax liability again.
You got it. Recognizing that you'll eventually have to pay tax on those development costs when you start using the asset, generating revenue.
Okay, I'm seeing the pattern here, but so far, mostly examples of deferred tax liabilities. Any common scenarios that lead to deferred tax assets when you're essentially prepaying your taxes?
Absolutely. Remember those provisions we discussed? Well, if a provision is recognized in the financial statements, but it's not tax deductible until it's paid, that creates a deferred tax asset.
Right, like setting aside money for warranties, but you don't get the tax deduction until you actually pay out those warranty claims.
Exactly. Another example is losses.
Losses. How can those lead to a tax benefit?
Well, in many tax systems, if a company makes a loss in one period, they can carry that loss forward, use it to offset profits in future periods.
So even though you've made a loss now, it might help you reduce your tax bill later.
Precisely. And that potential future tax benefit, that's recognized as a deferred tax asset.
Okay, so we're not just talking about owing more tax later. We can also have situations where we're effectively paying some tax up front.
Exactly. Timing differences, they can swing both ways.
This is making more sense now. What about fair value adjustments? Don't those sometimes create deferred tax issues?
Oh, they certainly can, especially when we're talking business combinations, one company acquiring another.
Mergers and acquisitions, always exciting.
They are. And when these happen, the acquirer often needs to revalue the assets and liabilities of the company they've acquired, bring them to their fair values.
So basically adjusting the values on the balance sheet to reflect what they're actually worth.
Exactly. And those fair value adjustments, they often create temporary differences because those fair values might not be the same as the tax bases, how those assets and liabilities are valued for tax purposes.
So if an asset suddenly becomes worth more after the acquisition, that could trigger a deferred tax liability, right? Because you might have to pay more tax later when you sell it or use it up.
Bingo! You're catching on quickly.
I'm trying. But dealing with deferred taxes in business combinations, it sounds like it can get pretty messy.
It can, definitely more complex, but IFRS 3 and IAS 12, they have specific rules to guide us through those situations, help us figure out how to recognize and measure those deferred taxes.
Thank goodness for those standards. Let's look at a real-world example, see how this all plays out.
Perfect. Our source material had this great case study about a company called TED. They acquired another company, Jason's, for $300,000.
Okay.
The net assets of Jason's at the time, $250,000, but there was one asset, their inventory, had a carrying amount of $50,000, but a fair value of $55,000.
So that inventory was worth more than what was on Jason's books.
Exactly. Fair value adjustment of $5,000 right there.
Okay, so what does that mean for deferred taxes?
Well, assuming a tax rate of 30%, that $5,000 fair value adjustment, it creates a deferred tax liability of $1,500 for TED.
So Ted's got to recognize that liability on their consolidated financial statements. What about goodwill? Does that come into play here?
Ah, good point. Remember goodwill, that intangible asset that represents the excess of the purchase price over the fair value of identifiable net assets. Well, that deferred tax liability, it actually reduces the net assets of Jason's, which in turn increases the amount of goodwill recognized.
So deferred taxes can actually impact the calculation of goodwill. Interesting.
It's all connected. You can't look at these concepts in isolation.
Okay, I'm starting to see the bigger picture. We've explored these temporary differences, deferred tax assets, liabilities, even seen how it works in a business combination. But I'm still a bit fuzzy on how we actually account for these deferred taxes. Where do they show up in the financial statements?
Good question. Deferred tax assets and liabilities, they usually hang out on the balance sheet. Sometimes they're classified as non-current assets and liabilities. Sometimes they get their own line items. Depends on the presentation.
So they're treated like any other asset or liability. Makes sense. What about the income statement? Where does the deferred tax expense or income go?
Generally, it ends up in the profit or loss statement, often as a separate line item.
So it directly impacts the company's reported profit or loss.
Exactly. But there are some exceptions, like when the deferred tax is from a business combination or certain transactions that hit equity directly, then it might be recognized in other comprehensive income or directly in equity.
All right, so special rules for special situations. Before we wrap up this deferred tax deep dive, one more thing. Offsetting deferred tax assets and liabilities, can you just net them against each other?
Ah, I wish it were that simple. There are rules, specific conditions that need to be met before you can offset.
Lay those rules on me.
First, you got to have a legally enforceable right to set off the amounts, meaning you can use the asset to reduce the liability. Second, the company has to intend to either settle on a net basis, meaning they'll pay or receive the net amount, or realize the asset and settle the liability simultaneously.
So no random offsetting. There needs to be a legal basis and a specific intention behind it.
Exactly. And one more detail, the deferred tax assets and liabilities, they got to relate to income taxes from the same tax authority.
So you can't offset a U.S. deferred tax asset against a U.K. deferred tax liability. Makes sense.
You got it. Offsetting can be tricky. Always double check the guidance in IAS 12 before making any moves.
This deep dive into deferred taxes has been incredibly helpful. It's a complex topic, but I feel like I'm finally getting it.
That's great to hear. And remember, deferred taxes, they're especially important for companies with complex operations or those operating in multiple countries.
Speaking of complex operations, we've got a couple more interesting areas to explore. Unrealized profits on intergroup trading and unremitted earnings. Those sound like they could lead to some tricky deferred tax situations.
You're right. Those are definitely worth exploring. Let's start with unrealized profits on intergroup trading. This comes up when one company in a group sells goods to another company within the same group, but those goods haven't been sold to an outside customer yet.
So internal sales within the group.
Exactly. And the tricky part is the selling company, they might recognize a profit on that sale, even though from the group's perspective, that profit isn't real yet because the goods are still within the group.
So it's a profit on paper, but not a real economic profit for the group as a whole.
Precisely. And that's why when we prepare consolidated financial statements for the whole group, we got to make adjustments, eliminate that unrealized profit.
Okay, I get that. But how does this tie back to deferred taxes?
Well, when we eliminate that unrealized profit for accounting, it creates a temporary difference. For the purchasing company, from a tax perspective, they did make a purchase at a certain price, so their tax base is unchanged.
But from the group's perspective, the profit isn't real yet.
Exactly. And because of that difference in treatment, we end up with a deferred tax asset.
So even though we're eliminating the profit in the books, it'll eventually be taxed when those goods are sold to an outside customer.
That's right. And that deferred tax asset, it represents that future tax benefit.
Okay, I'm starting to see the light. Can we go through a specific example to make this crystal clear?
Absolutely. Our source material features Alpha Ltd. They own 80% of Beta Ltd. During the year, Alpha sells some inventory to Beta for $250,000, making a 40% gross profit margin.
Nice profit margin.
But here's the catch. At the end of the year, Beta still has a quarter of that inventory on their shelves, unsold.
So some of that profit Alpha recognized isn't actually realized for the group.
Exactly. We got to figure out how much is unrealized. The gross profit on the sale was $100,000. That's 40% of the $250,000. And since 25% of the inventory is still sitting there, the unrealized profit is $25,000.
So when we consolidate, we got to make that $25,000 adjustment.
Right. Reduce the cost of sales by $25,000, reduce the inventory by $25,000, eliminate that unrealized profit.
And what about the deferred tax impact?
Assuming a corporate tax rate of 20%, that elimination creates a deductible temporary difference, which leads to a deferred tax asset of $5,000.
So even though we've adjusted the profit, the group is still in a position where they've effectively prepaid $5,000 in taxes.
That's a great way to think about it. It'll all even out eventually when Beta sells that remaining inventory, and the profit is realized for both accounting and tax.
That example really clears things up. Those internal sales within a group, they can definitely lead to deferred tax assets. Now, what about unremitted earnings? How do those impact deferred taxes?
Unremitted earnings, sometimes called undistributed profits, another area where deferred taxes can pop up. We're talking about the portion of a subsidiary's, associates, or joint ventures profits that haven't been distributed to the investor.
So it's the profit that's been kept within the company rather than being paid out as dividends.
Exactly. And this can create temporary differences when we look at how the investment is valued for accounting versus tax.
Okay, how do those values differ?
In the consolidated financial statements, the investment is typically valued at the investor's share of the investee's net assets, plus any goodwill, that's the carrying amount.
And for tax?
Tax base is often the original cost of the investment.
So if the company you've invested in has been doing well, reinvesting those profits, the carrying amount of your investment is going to be higher than its tax base.
You got it. And that difference, that's essentially the unremitted earnings.
So we have a temporary difference, but does that automatically mean we need to recognize a deferred tax liability?
Not always. IAS 12 has a specific exemption for unremitted earnings. You don't have to recognize deferred tax on those temporary differences if two conditions are met.
All right, what are those conditions?
First, the investor needs to have control over when those temporary differences will reverse, meaning they can decide when those earnings will be distributed.
So if they can determine when dividends will be paid, no deferred tax, makes sense. What's the second condition?
It must be probable that those temporary differences won't reverse in the foreseeable future.
So if it's unlikely those earnings will be distributed anytime soon, we can also skip the deferred tax recognition.
Exactly. And those exemptions, they make sense when you think about the logic of deferred taxes.
Okay, remind me of that logic.
Deferred taxes, they're all about recognizing the future tax consequences of those timing differences. But if the investor controls the timing and it's unlikely to reverse anytime soon, then there's no real future tax consequence to worry about.
That makes sense. So when would we actually recognize deferred tax on unremitted earnings, and when would we get a pass?
For subsidiaries, the parent company usually controls the dividend policy, so in most cases you won't see deferred tax on unremitted earnings from subsidiaries.
Because they have the power to decide when those earnings will be paid out, what about associates and joint ventures?
That's where it gets a bit more nuanced, because the investor might not have as much control over those dividend decisions.
So in those cases, recognizing deferred tax might be unavoidable.
That's right. Really depends on the specifics, how much influence the investor has over those dividend payments.
Okay, I'm getting a much better grasp of this. What about revalued financial assets? Do those ever create deferred tax issues related to unremitted earnings?
They can. Imagine you have a financial asset, like an investment in an associate, and its value increases.
Okay.
That can create a temporary difference similar to unremitted earnings.
So the value of the investment on the books goes up, but the tax base stays the same.
Exactly. And in those situations, you generally need to recognize deferred tax on that increase, unless those two exemptions we discussed earlier apply.
This has been a fascinating look at unremitted earnings and deferred taxes. It's amazing how these timing differences can pop up in so many different areas.
It really shows how interconnected the accounting and tax worlds are.
Before we move on, one more area I'd love to explore: how deferred tax intersects with the world of leases. IFRS 16 shook things up quite a bit, and I'm curious about the deferred tax implications.
Great point. IFRS 16 definitely added another layer of complexity to those calculations. Remember, lessees have to recognize an ROU asset and a lease liability for most leases.
Right, bringing those obligations onto the balance sheet.
Exactly. And because the way we account for leases under IFRS 16 doesn't always match up perfectly with how they're treated for tax, it can create those temporary differences we've been talking about.
So we need to look at the lease agreement, see if there are any differences, when those differences occur, and whether they're going to lead to deferred tax assets or liabilities.
Precisely. Let's look at a case study from our source material, see how this works in the real world.
I'm all about real-world examples. They always make things click for me.
Our source material talks about Panel Co. They're leasing some plant equipment over 5 years. At the start of the lease, they recorded an ROU asset of $12 million. That's the present value of their lease payments. And they're depreciating that asset on a straight line basis.
Okay, standard IFRS 16 treatment so far. What about the payment structure?
Annual lease payments, $3 million, payable in arrears on October 31st each year. Effective interest rate is 8%, and here's where the tax side comes in. They can claim a tax deduction for that annual rental payment, but there aren't any special tax breaks for this particular lease.
So accounting treatment and tax treatment are different, which means
Deferred tax potential.
bingo. To see exactly how it plays out, we got to walk through the accounting, then analyze those temporary differences.
Let's do it. Starting with the ROU asset, it's depreciated over 5 years, so that's an annual depreciation expense of $2.4 million.
$2.4 million each year. Got it. What about the lease liability?
In year one, the interest expense would be $6 million. That's 8% of that $12 million lease liability. And after they make their first payment of $3 million on October 31st, the liability is down to $9.96 million.
Okay, so comparing the carrying amount of the ROU asset and the lease liability at the end of year one, the ROU asset is down to $9.6 million after depreciation. And the lease liability, which is basically our tax base in this case, is $9.96 million.
You're on fire with those numbers. So we can see the lease liability is higher than the carrying amount of the ROU asset.
Wait a minute, does that mean this lease is actually creating a deferred tax asset?
You got it. We've got a temporary difference of $0.36 million. And because the liability is greater, it results in a deferred tax asset. To figure out the exact amount, we'd need the company's tax rate, but the key takeaway is this lease scenario is giving rise to a deferred tax asset.
Mind blown. This really shows how IFRS 16 can shake things up on the deferred tax front.
It's all about those timing differences. And this highlights why it's so important to analyze leases from both an accounting and a tax perspective.
Okay, we've covered provisions, contingent liabilities, deferred taxes. It's amazing how many moving parts there are in financial reporting.
It's a complex world out there, but there's one more important topic we should touch on. It often pops up in the ACCA syllabus, accounting for share option schemes.
Share options, yeah, those definitely have tax implications.
Absolutely. Share option schemes, they're a way for companies to give employees the right to buy shares in the company at a future date, usually at a discounted price, a way to incentivize and reward them.
Okay, so how do share options connect to deferred taxes?
Well, for accounting, the company needs to recognize a cost, called a remuneration expense, over the period those share options vest.
So if the employees need to work for the company for a few years before they can actually use those options, the company spreads the cost over those years.
Exactly. But here's where the tax man throws a wrench in the works. Tax relief for those share option schemes, it's usually granted only when the options are actually exercised, not when the cost is recognized in the accounts.
Another timing difference.
You got it. And because the expense is recognized earlier for accounting than for tax, it creates a deferred tax asset.
So the company is recording the cost now, but they won't get the tax benefit until later.
Precisely. The amount of that deferred tax asset, it's based on the intrinsic value of the options. That's the difference between the market value of the shares and the price the employee can buy them at.
Okay, let's use an example, see how this works.
Our source material has this case study about Aqua Ltd. They gave share options to their directors starting July 1st, 20x8. Each director can get 25,000 options if they stay with the company for 4 years. The fair value of those options at grant date was $10. The exercise price with the director's pay is $5, and the market price of the shares at the end of June 20x9 was $17.
So let's break it down first, the expense.
For the year ending June 30th, 20x9, the company recognizes a total expense of $250,000.
Okay, got it. Now the deferred tax asset, how do we calculate that?
Well, the intrinsic value of each option is $12. That's the $17 market price minus the $5 exercise price. And since only a quarter of the vesting period has gone by, the tax base is $300,000.
So with a tax rate of 30%, the deferred tax asset would be $90,000.
You nailed it. But remember, this asset, we can only recognize it if it can be measured reliably and the company believes they'll actually be able to use it, meaning they'll have enough profit in the future to offset against this tax benefit.
Just like any other deferred tax asset, got to be cautious. Make sure it meets the criteria before we put it on the books.
Exactly. Share option schemes, they're a great illustration of how those timing differences between accounting and tax can create deferred tax assets.
We've covered a lot of ground today. Revenue recognition, leases, provisions, contingent liabilities, deferred taxes, even share option schemes. It's amazing how interconnected all these areas are.
It's all part of the fascinating world of financial reporting.
It is. But, we've mainly focused on the lessee's perspective, the companies using those assets.
Ah, good point. What about the lessors, the companies leasing out those assets? How would things look from their side?
That's a great question. We haven't really dived into their accounting in those deferred tax calculations, have we?
Not yet. How would the revenue recognition, the expenses, and the deferred taxes differ if we put on the lessor's hat? I think that's something worth exploring further.
That's a fantastic point, something for our listeners to ponder. So let's flip the script and look at things from the lessor's perspective, the companies that are leasing out those assets.
It's a whole different ballgame, remember. Under IFRS 16, lessors still get to classify leases as either finance leases or operating leases, just like under the old IAS 17.
Right, so while lessees have to put most leases on the balance sheet, lessors have more flexibility.
That's the key difference. And this classification, it drives how they recognize revenue and how those deferred taxes are calculated.
Okay, let's break it down. Starting with finance leases, the lessor basically views it as a sale, right?
Exactly. They de-recognize the leased asset, put a lease receivable on their books instead, and recognize finance income over the lease term.
So if the lease payments are structured in a way that they exceed the carrying amount of the asset over the lease term, the lessor is essentially making a profit on the lease.
That's right. And this profit, it might be taxed differently than the finance income they're recognizing, which creates, you guessed it, a timing difference.
Those timing differences, they always come back to haunt us.
They do. So depending on the tax laws, the lessor might have to pay more tax up front than what they've recorded as income.
Leading to a deferred tax liability.
You got it. Finance leases, they can definitely trigger those liabilities for lessors.
Okay, so finance leases, potential for deferred tax liabilities. What about operating leases? Since they're not recognizing a profit immediately, can we forget about deferred taxes in those cases?
Not so fast. Even with operating leases, there's still the possibility of timing differences between when the rental income is recognized and when it's taxed.
So we got to scrutinize that lease agreement, see if any temporary differences are hiding in the fine print.
Absolutely. And those differences, they could lead to either deferred tax assets or liabilities. It all depends on the specifics.
This really highlights the importance of understanding both sides of the lease, the lessee and the lessor. It's amazing how the same transaction can have such different accounting and tax implications depending on whose shoes you're standing in.
It's all about perspective, and it's a reminder that mastering financial reporting, it's not just about memorizing rules, it's about understanding the nuances, applying the principles thoughtfully.
Well said. This deep dive has been incredibly insightful. We've explored so much: revenue recognition, leases, provisions, contingent liabilities, and of course the often perplexing world of deferred taxes.
It's been quite a journey.
It has. We've seen how these concepts can significantly impact a company's financial statements, and sometimes how they can be used to, well, maybe not hide things, but certainly obscure the true financial picture.
Transparency and accuracy, those are the pillars of good financial reporting. And as we've seen, even small timing differences can create substantial deferred tax assets or liabilities, which can paint a very different picture of a company's profitability.
Couldn't agree more. For anyone trying to understand financial statements, whether you're an investor, an analyst, or just someone curious about business, being able to spot these nuances and grasp their implications, that's crucial.
It's all about developing a critical eye, not just accepting things at face value, ask questions, dig deeper, challenge the numbers. That's how you get to the truth.
This deep dive has been a fantastic reminder that financial reporting is a constant learning curve, new standards, new interpretations, new challenges. It never gets boring.
That's what keeps it exciting. It's a puzzle that's always changing, always evolving.
Absolutely. So to all our listeners, stay curious, keep learning, and remember, even the most complex financial reporting concepts, they become much clearer when you understand the underlying principles.
And never underestimate the power of a good deep dive. It's amazing what you can discover when you take the time to really explore those financial statements.
Couldn't have said it better myself. Thanks for joining us on this journey through the world of financial reporting, and until next time, happy accounting.